Question 749. John is currently keeping $5,000 in an impound account on a trust deed on which he is getting payments from Gwendolyn. Which of the following is true regarding the impound account? A. The account can never exceed $5,000. B. The account must have a balance maintained that is equal to 1 year's taxes and insurance. C. The account can generate interest for John if he keeps it in a saving bank. D. The account benefits the trustor and the beneficiary. Correct answer is D. The account benefits the trustor and the beneficiary. An impound account, also known as an escrow account, is generally set up by the lender to collect funds from the borrower to pay for property taxes and homeowners' insurance premiums as they become due. The purpose is to ensure these critical payments are made, protecting the lender's security interest in the property. The balance in an impound account fluctuates. It typically builds up between tax and insurance payment due dates and then decreases when those payments are made. The required balance is tied to the amount of taxes and insurance, not a fixed cap like $5,000 unless specified in a very unusual loan agreement. Federal regulations, like RESPA, and common lending practices allow lenders to collect a cushion, typically equal to 2 months' worth of impound payments, in addition to the amount needed to cover upcoming tax and insurance bills. So, the balance will generally exceed 1 year's taxes and insurance at certain points, especially right after a payment is made and before the next major bill is due. The account collects enough to pay a year's worth, but the balance maintained isn't a fixed year's worth. In the scenario, John is the beneficiary, lender, receiving payments from Gwendolyn. The impound account holds Gwendolyn's money to pay her taxes and insurance. In California, lenders are generally required to pay interest on impound accounts if the loan is secured by a 1 to 4 family residence. This interest is credited to the borrower, Gwendolyn, not the lender, John. So, if the account generates interest, it benefits Gwendolyn, not John. The primary benefit for the lender, John, is that it ensures property taxes and insurance premiums are paid on time. This protects the lender's collateral, the property, from tax liens and ensures it's insured against damage, reducing the lender's risk. For the borrower, Gwendolyn, it offers convenience. Instead of having to save up large lump sums for annual or semi-annual tax and insurance bills, they pay a smaller, manageable amount each month along with their mortgage payment. It also prevents them from inadvertently missing these crucial payments. Therefore, the most accurate statement is that the impound account benefits both the borrower and the lender.